Hello everyone and welcome back to Deep Stock Analysis. I hope you are all doing great. In today's episode, we will dive into an interesting stock that's been catching my attention this week. So straight away, let's get started. So I selected Ajats Engineering after researching several stocks because it passed most of my screening parameters. Ajats Engineering is a Karnataka-based company is specialized in concreting equipment, essentially offering a 360-degree concreting solutions. They are the market leader in self-loading concrete mixers and currently operating three manufacturing plants, all in Karnataka, with with a fourth one under construction that's almost nearing completion, that is also in Karnataka. The company also exports to over 45 countries, African countries, Middle East countries, even to European countries. It's a relatively new listing on the stock market in February 2025. Overall, the company has a strong product base, though its performance can be influenced by cyclic trends since it largely depends on infrastructure growth. However, considering India's long-term growth focus on infrastructure development, being a developing country, I believe Ajat Engineering holds strong growth potential in the coming year. Let's now move to the next slide to explore its fundamentals. So as you can see here, the company has a decent market capitalization of around 6,500 crores, more than 6,500 crores, placing it comfortably in the mid-cap category. It carries negligible debt around 1 CR and holds a healthy amount of cash, which gives confidence in its financial stability. Overall, the basic fundamental looks pretty strong. Let's dive a little deeper into the fundamentals. So Ajit's Engineering has shown a steady growth in the revenue from 740 crores in 2021 to about 2074 crores in 2025, which is quite substantial. Even operating profit has also grown impressively from 129 crores to 318 crores in 5 years, which is more than double in 5 years. Now, if we look at the cash flow, you can see there is a decline. So this is mainly due to delays in receiving the payments from customer. Something common in this industry, especially when dealing with large clients or government projects, where longer credit periods are very normal in this industry. However, it's always important to monitor the cash flow every year, particularly if you are planning for a long-term investment, because consistent negative cash flow can limit to a company's growth potential. Let's go to the next slide for a better analysis. So here we are going to talk about return of capital employed and return of equity. So both ROC and ROE looks impressive, almost double the company's cost of capital and cost of equity. This clearly indicates that strong value is creating for both investors and shareholders. So if Ajat Engineering continues this trend, it's well positioned to create significant long-term wealth, not just for the company, but for its shareholders as well. So as I mentioned in my previous episode also, cost of capital is something the minimum return which an investor will expect by considering the economic factors like what's the minimum interest they received by investing in the FD and from the overall Nifty or census average. Also, we add this beta of the company, that is the risk of the company involved in it. So by including everything, an investor will expect a minimum return. So that is the cost of capital or cost of equity. Cost of equity is considering without any debt, cost and reducing the cash. Cost of capital means here we will consider the debt also. So if you compare cost of capital with ROC, it's more than double. And cost of equity, if you compare with ROE, it's almost double. So the company is creating a good value. If it was equal or lesser, if ROC is lesser than cost of capital, that company was destructing the value. Here company is creating more values. So that is a good part. So fundamentally it's strong. Let's go to the next slide where it is more about the debt. So as mentioned earlier, Ajit's Engineering carries very minimal debt, which means the profit can be fully channeled toward business expansion or rewarding shareholders through dividends in future. So this financial flexibility allows the company to grow faster and sustain momentum. Additionally, the strong credit rating, which is AA, further boosts confidence in Ajit's engineering financial stability. If you move to the shareholding patterns, we can see the promoter holding is 80%, which is very good sign and reflects strong confidence in the company. There is also a decent level of institutional holding, almost plus 15% plus, further supporting stability. And public shareholding is less than 5%, which means stock generally trades with a lower volume. Because of this, even there is a phase of panic selling for any reason, it usually happens with low volume comparing the total size of the company. So the price may dip temporarily, but has a good chance to recover quickly once stability return or for any other trigger. So promoters and institutions typically don't sell in panic, which helps in the stock remain relatively stable in the long run. So overall, from a fundamental standpoint, Ajit's engineering looks pretty strong. Let's now move on to the valuation analysis to see whether the current price offers a good entry opportunity or if it's still overvalued. Well, let's go to the valuation analysis. So as you can see here, it's okay. So if you look at the valuation, it appears quite reasonable. The PE ratio is below 30, which when comparing to its peers, look fair or even slightly better. The PEG ratio is under zero point 0.5, indicating that PE is well supported by earnings growth. Or in other words, I can say the company's past growth has outpaced its valuation. The same goes for EV or EBITDA. It's at a comfortable level, reflecting decent valuation support. Now, looking at the price trend, the stock has corrected nearly around 25 to 30% from its all-time high. The recent decline could be attributed to the broader sector weakness as the entire construction equipment industry hasn't been performing well. Additionally, the Q1 result were very encouraging. If you see the profit, there were a decline year-on-year basis, and there wasn't much improvement in the net sales either. It's almost same. So the Q2 results are yet to be announced. Since Q1 numbers were weak, expectation might already be low. So if the Q2 performance surprises positively, the stock could see a sharp recovery. However, another poor quarter may lead to further downside. So it's worth waiting to see how the upcoming results play out before making a major decision right now. Since I guess the Q2 result will be announcing in a 1 or 2 weeks time. A aggressive investor may add some position at this time because right now the valuation look decent, but who are conservative may have to wait until the result publish. So here I will take some time for chart analysis also. This is a 1 day time frame chart. As you can see, the price is currently near a key support zone. That's the starting, but a short-term downtrend is still visible since the 20-day moving average remains below the 50-day moving average. The stock has also entered a oversold zone, which could signal a possible reversal or a consolidation phase. Now, this setup looks like a great example to apply Richard Wyckoff method. So if the price starts consolidating around this zone, it could be forming an accumulation phase. And any breakout from here might lead to the potential upside of around 30% in short term. However, it's always wise to keep a stop loss based on your risk tolerance. Since Ajit's engineering has a strong fundamentals, a long-term buy on dip strategy can work here. But always remember, buy on dip doesn't mean buying at every dip. Wait for signs of consolidation before re-entering if price moves lower. Also keep an eye on the quarterly result for short-term swings. Watch the volume closely during consolidation. So if volume rises when the price moves up, that's a bullish sign. But if volume increases during the price declines, it may suggest further weakness. So currently the stock seems to be stabilizing and a reversal could be on the horizon. because a handle stick with a small upper wick has formed after a long downtrend, hinting a possible trend reversal. But I feel like conservative investors can wait for confirmation over next few sections, while aggressive investors may consider entering early with a strict stop loss. Make sure your stop loss is there or have a buy on dip strategy. Buy on dip means buy when the price is getting consolidated at the next level and hinting there is a chance for reversal. So let's move to the final conclusion side. So we are at the final slide here. As we have seen, Ajit's Engineering currently stands at a decent valuation with a strong financial base and healthy fundamental. The price trend, however, is still showing a downward movement. So for conservative investors with a long-term view, it's better to wait for a of confirmation, bit of confirmation before entering. But for an aggressive investors, this could be seen as an early opportunity provided you maintain a strict stop loss or follow a buy on dip strategy. And again, it's very important. Buy on dip doesn't mean buying at every fall. Focus on adding position only when stock consolidates. So considering India's strong outlook for infrastructure growth, Ajit's Engineering with its sound balance sheet and healthy cash reserves appears well positioned for long-term growth. And let me know your thoughts in the comments and feel free to remind me if I have missed out any points or if you would like me to cover more points in the future videos. Many thanks for your attention and hit the subscribe and like button. It will be motivating me. Thank you all. As a final slide, I would like to go through disclaimer as well. Please have a look at this. Thank you all. Bye bye. Have a great week. Happy investing.